What's up, financiers? It's E of E&L Finance. In this video, we'll be discussing two real estate investment trusts, or REITs for short, with a 5% dividend yield and room for growth. Stay tuned to the end for some great news. But before we begin, if you're into stocks, investing challenge, and innovative ways to invest, please hit that big old subscribe button and join the bear bull of YouTube. The first company we'll be talking about today is similar to Realty Income, ticker symbol O. The big difference between these two is that this company is smaller, referring to market cap and properties owned. It's less popular and pays a quarterly dividend compared to O, which is a monthly paying dividend. The company we are referring to is Spirit Realty Capital, ticker symbol SRC. Spirit Realty is a net lease REIT, which means it makes its money off of long-term leases to other businesses. Taking a closer look at this company, we see that they provide single tenant and triple net properties that span from retail, distribution, and service-oriented industries. Their lease terms are 10 to 20 years, which is great because it allows the company to have a consistent, sustainable income, which turns into sustainable dividend payments for us investors. As of December 31st, 2020, they have over 300 tenants with 1,860 properties that are in 28 different industries. This gives them a 99.6% occupancy of their properties, along with managing $6.8 billion portfolio. That's some impressive numbers right there, but who are their tenants that are able to maintain these long leases, given everything that has been going on with business closures, and how are they able to maintain such a high dividend? Taking a look at their top 10 tenants, we can see why this company is able to grow along with pay such a sweet dividend. Their top 10 tenants consist of Home Depot, BJ's Wholesale Club, Walgreens, CVS, Church Chicken, Dollar Tree, and Family Dollar. This explains why they're able to pay a dividend of a whopping $2.50 annually, which equals to 62 cents per share every quarter, which is crazy high for a REIT, as most REITs fall between 3 to 4% of a dividend yield. Our thoughts on the stock is that it's going to continue to transition their portfolio away from leases of companies that may be more risky in maintaining rental obligations, and continue growing and providing space for companies like Home Depot and BJ's, who are distribution-based businesses. Looking at their 2020 acquisitions, they have acquired more distribution-based leases compared to their other acquisitions last year. The next REIT went on a spending spree as it continues to acquire more medical buildings to lease out. Just last quarter, it bought over $200 million worth of properties compared to the $70 million they spent in recent quarters. This year alone, they're expected to spend $500 million acquiring more buildings at a discount, of course, as they continue to expand their rental properties. This company is Physicians Realty Trust, ticker symbol DOC. DOC is a self-managed healthcare real estate company which leases properties to physicians, hospitals, and healthcare delivery systems. The company currently owns 268 properties, 93% of its portfolio is medical offices, and 89% of its tenants are affiliated with major health systems. The company recently reported a fourth quarter total revenue of $114 million, an increase of 3.7% over the previous year. They generated a fourth quarter net income of 8 cents per share. DOC is relatively a young medical REIT, but even though it's still young, it was able to build a portfolio of healthcare real estate worth close to $5 billion. Not only that, but it has paid what's going to be now its 31st consecutive dividend, powered by the company's belief in its strategy that best anticipates the future of healthcare delivery and that it will continue to drive opportunities for growth. Did I mention they paid an annual dividend of 92 cents, which equals 23 cents per share? Our thoughts on this company is that it's hungry, and when a company is hungry, it's looking to dominate. If spending $500 million to acquire more properties at a discount, of course, is showing a hunger to grow and compete, then I don't know what to tell you. Maybe you're looking for the next penny stock that can potentially boom, but DOC is here to stay and continue to provide that lovely dividend. Before we end today's video, we have some great news for you. There's still time to own shares of these companies to receive a dividend payment for the month of April, as these EX dividend dates for the two companies fall on March 30th and 31st. Hope this video was helpful in some way, and if you don't mind, hitting that like button, it will be greatly appreciated. If you enjoyed today's information, tap that subscribe button and come join the team. We have fun over here with the content we provide. We're all looking to create passive income and continue wealth. See you guys in the next one, and remember to follow the 3 M's. Money makes money.